So in the last video, we learned how to build the algo for a CWAP or swing-based trade. So you can see the swing-based trade here came off of the CWAP using the volume-weighted average price as the trailing stop, and you can see that this has gone up and produced now a double top. The next thing that we've got to learn is how to apply a decision point algo. So decision points are when we have reversals. Before we jump to that, I just want to note that once you have an algo set up the way that you want it, it's a good thing to come down and just hit your save defaults, and that way no matter what you change this to, if you happen to be trading off of the value low price or something like that and you go, oh wait a minute, I need to send the order to the CWAP, when you do that it'll pull back all of your settings for that CWAP trade. So it makes it really simple to just single click it by saying this is where I want to send the order. So let's take a look over at the ES. I've got a decision point down here at the bottom that we can work off of. The decision point is the low of the morning. We then lift back up off of the low, trade back into the range, and then later on in the morning we come down and we trade into the decision point. So you're going to use this off of the prior day's highs and lows, major reversals, key pivots on the chart. If you decide to go into the advanced training, there's a lot of detail about specifically how you want to derive these points, why you shouldn't just be randomly placing decision points all over a chart, the best shapes and the best value that you're going to get out of decision point trading. We really break that down for you in some of the advanced training. In this case, what I'm trying to do is show you what the actual algo looks like. So let's review the concept. What we're doing is picking a major pivot on the chart, a key point, in this case the low of the day that traded off in the US pre-market when we came back into the range. And what we want to do is understand that we have a zone of support that is created by the value area of a key pivot transition. So we have the market moving down, the sellers trying to continue, and then the buyers flushing them and turning the market around. That's a transition, and we call that a key decision point when it comes in at key pivots throughout the day. So there's this zone of support that is created by the value area, and we could trade off of the top of value and use the bottom of value as our stop. That's one way that you could build this out. But for the training, specifically the markets that I've shown you, the ES, the YM, the CL, and the E-mini S&P, my feeling is that the point of control generally will give you a very good entry and a super low risk. The idea is that we're trying to risk as little as possible on these trades. And the reason behind that is simple. We're not looking for these to turn into monster trades. We're looking to pick up a quick multiple on what we risk. So for example, if I were to enter this at the point of control and use the bottom of value or one tick outside of it as my stop, I would have a 1, 2, 3, 4, 5 tick stop, and I would be looking to make 2 or 3 to 1 out of it relatively easily. So I would need to get 15 ticks off of my entry to make 3 to 1. That's not very hard to do, right? Now for this to turn into a full trade, that's a whole different animal. Right? And everybody loves to have these great big winners, but I'm going to tell you, a smart trader doesn't care about where the market goes. He's looking to make 3 to 1 on his money. And if you make 3 to 1 on your money, you are trading in the highest percentage of profitable traders out there, period. So you should be interested in making 15 ticks, not 300 ticks. If you can make 15 ticks, you're making 3 to 1 on your money on a trade like this, and trust me, it puts you in the absolute pinnacle of successful traders. If you're chasing the dream of the big trade, you will forever be chasing the dream. It's called an elephant hunt. Don't know how else to put it. So in this case, what we're going to do is send our order to the point of control, and we're going to use the value area as our size off. Okay. Now this could obviously be a short trade as well. So if we were to go and find a high, let's just draw one up here real quick. So here's a high area that we might trade off of. In this case, we would be looking to short at the point of control and using the top of value as our trailing stop. Well, we don't want to have to build separate algos for longs and shorts. So what we're going to do is build an execution algo that goes either direction. It doesn't matter which way it goes, right? So we're going to open up our interface for the algo. We're going to create a new execution algo, and we're going to call this one value. And again, I'm just going to use 2% as my baseline for this, okay? And what we're saying is, remember, the naming convention is not what I'm trading off of. I'm trading off of the point of control. The naming convention here has to do with what I'm sizing off of, Okay, so what is my initial stop going to be up against? It's going to be up against the value area. Now again, you can add in your commission here if you want to be precise about it. Actually, that's not correct. I can't remember what my ES commission is. I'll leave it at $3.98. And then we have to establish what we want to size off of. Now this is where it gets important. If you open up the list, you're going to see two factors that deal with value. So VHP means value high price, VLP means value low price. Okay? Because there's another one right under it that is just the inverse, so this one's VHP VLP and this one's VLP VHP. Well, why do we have two? Well, we have two because it depends on which side of value you want to use for longs and shorts. So the naming convention is always this way. Whatever is first is what you would use in a long. So let's think about our long, and let's assume that we use the value high price here, just as an example, for our long. Okay? Let's think about what would happen. So I'm saying I want to go long at the point of control, but I want to use the value high price as my stop. That doesn't make any sense, does it? So a long, I need to use the value low price as my stop. And the naming convention is whatever acronym is first is going to be the one that we use for a long. Whatever second will be what we use for a short. Let's go back in and look at that. If I create that execution algo with value 2%, 2% and $3.98, then I need to use the value low price with the leading acronym, right? That means that a long will come off of the value low price. Now, once again, I'm going to offset this. I want to get a tick behind it, which means down here, I'm not using this last blue level here as my stop. I'm going one tick outside of it. Okay. Again, I would leave the majority of this blank. I would make your minimum stop something like 2 ticks so that you just don't get caught in a trade that your entry and stop are on top of each other. And if you want to include your open risk in your sizing, that's a smart way to go. So we're going to say add on that one. And now when we go and look at our execution algos, we can select value. So we know it's there. Okay. So we're going to send our trade to the point of control. Right? Now we could send it directly to the point of control. We could send it 1 tick behind the point of control, or we could lead it by a tick. My recommendation is that you lead it by a tick. That's just personal preference here. So again, for every market, it's going to be a little bit different. You're going to find some markets don't respect the point of control, that you need to get into them at the edge of value. You need to use the entire support zone here. Other ones, really, as I said, in the advanced training, you're going to learn all about the shapes of these profiles and how important that is. And so as you have specific shapes in mind, it may alter where you want to put the order in. You may want to go in right at the point of control, or tick behind it, tick in front of it, 2, 3, something like that. As your experience grows as a trader and you focus on a single or a couple of instruments, you're going to find these things out very, very quickly. It's just a process of collecting data. You are researching that instrument while you're sim trading, and you're going to start to learn the nuances of it. All right, so we know that 1 tick in front, we're going to use our value execution. And then for the take profits, we can really do the exact same thing. We almost don't even need to create anything different. So we're just going to use the standard 5 here and take 100% off. Now again, you can create another variation of that where you don't take 100% off. If you want to be able to capture a move like this where it continues to go and move up, you might want to just let it run its course. And then for management, we've already built the algo. Okay, we've already built it. This is our simple VWAP. There's not really any need to change that at this point in time. Again, as you improve and really start to understand the markets that you're trading, you're going to find the nuances. A very good example is how I trade the U.S. equity open at 8:30 in the morning. If I'm specifically trading a value-based strategy for a breakout at the 8:30 open, that's 8:30 Central, so the U.S. equity open, I will generally expect that the market is going to move quickly in one direction and then turn around. You can kind of see it here. This is the 8:30 open. We jump up and we turn right back. It's very important in those times, or if you're trading a report, that you use something that captures more of your, that increases your trailing stop faster. So in that particular scenario, I might be using the first standard deviation as my trailing stop after I get to a certain level. And so it makes sense that in my management setup, I select that particular algo so that I'm not having to move the stop or worry about the market getting whipped back and forth. For starting out, the best thing that you can do is keep it very simple and just use the simple VWAP. Okay, so in a trade like this, it's basically all set up. One thing that I'm going to suggest that you do anytime you're using value as your execution is that you use the sticky stop. Okay, and what the sticky stop does is it allows your stop to move with the value area. Remember, a value area is always going to increase and decrease. It's going to get bigger and smaller, and it's going to move around quite a bit. Whereas something like the VWAP is always going to be, because it's an average by nature, it's going to be a little bit more consistent and slowly moving. If you use a sticky stop, your stop will track the edge of value the entire time. If you don't use it, it's always going to be the best position that the edge of value was in. So, for example, in this particular instance, the value area low right now is 23.45 quarter. As this starts to move over, now it goes up and it is 23.46. Okay, so my stop would be moving up with that. Let's just say, for the purposes of discussion, that then the value area moved back down because there was other trading, and it moved back down to 23.45. If I don't have the sticky stop on, my stop is going to stay up here at 23.46. It's going to stay where the best position was. In other words, it's only going to make your stop better. It will never move your stop back out. That's good from the sense that you're not risking any more than you've improved your stop. There's no reason to stretch it back out. However, if you're following the logic of a value area and you understand what that means, that there is a significant amount of volume in some place at which the market should have a difficult time trading through, then it makes sense that you want your stop to move with the value area. So my suggestion is, on any trade that you're using value as one of your management characteristics, in this case our initial size off, my suggestion is that you use the sticky stop. So once again, you can save this as your default. And now anytime I select a POC trade, it's going to come up. So if I go to my VWAP trade, and then I come back to my POC trade, boom, it's all pre-calculated for me. Okay? We're going to build one more algo and we'll be all set.